Hello everyone, welcome to lecture 3 of this series. So today I'll be talking about uh, AMD Framework, which is Accumulation, Manipulation, and Distribution Framework. Basically, how it works for buy and sell models. So in the last lecture, I know we explored why prices drawn to certain levels, like liquidity zones, imbalances, and institutional levels. But if you're here to see those videos, make sure you check them out. Like I said, today we'll be taking it a bit further by talking about one of the most powerful frameworks you will ever learn. It's a powerful structure used by institutions and algorithms. It's known as the market maker model, and it was based on AMD framework. And what's AMD, like I said earlier, is accumulation, manipulation, and distribution. And this is the blueprint of behind many of the moves you see every day on the charts. And as always, anything I show you here is not just a theory, it's a recurring pattern on charts that is observable and you can check out yourself. So market model is about basically how smart money engineers liquidity before executing the real move, and this happen in three phases. The phase one is where they accumulate volume in a tight range. Phase two is where they manipulate price to trap retail traders and trigger liquidity. While the phase three is distributing stage, and this is where price is distributed in the actual direction where they plan to move all along. As said earlier in my previous videos, the market makers don't just jump into the market, they prepare the ground, and they use AMD to do that. How they accumulate price. So the accumulation is where smart money they build positions quietly, and then the manipulation stage is where markets create false moves to grab liquidity and to trick retail traders to get into the market. And then the distribution stage is where the real move happen, where the intended trends play out, which is where they want to go all along. So think of the market as a machine, or like I said earlier, the algorithm, and it delivers price in three distinct phases: the accumulation phase, manipulation phase, and the distribution phase. And as said, this is the blueprint behind many of the moves you see. But this is how it looks like. So you have the accumulation, which is what can be referred to as consolidation. And then you have manipulation, which is an expansion to the opposite side. And then from the manipulation, you have a reversal, which gives you an expansion to where price intends to move all along, and it's going to take out all the liquidity that has been engineered prior to the distribution phase. And you see these three phases repeat daily, weekly, even intraday. You see them repeat on almost every time frame in the market. Now, knowing how to identify this can give you a major edge and know how to really follow the big move. So this pattern appears in both buy models, which is the bullish move, and sell models, which is the bearish move. Now, these steps are just mirrored, but the logic and the framework is the same. So let's talk about buy and sell models. Now, buy and sell models, the accumulation phase in the buy and sell model is the accumulation phase is the loading zone. I said earlier, institutions build their position in a narrow consolidation range, a tight range. The algorithm is programmed to stay within a particular range for a particular period of time. And this happens often during off session periods or around major sessions like you have can be the Asian session, can be pre-London session or pre-New York, depending on when the algorithm intends to deliver the price or depending on when the distribution is going to happen. That is when you will see the consolidation range. So what are the things you look out for in an accumulation phase? You will see sideways price action. So you look out for sideways price action. You look out for low volatility and that market is not really moving like that. And then look out for false signals in both directions. When you see price generating a CV and a BC, and then they are both failing, so it traps buyers and traps sellers. That is the loading zone. So it's trapping many others. When you see price, you may think price wants to go up, then it creates a bullish fair value gap, and then breaks the gap again, then creates a bearish fair value gap, and then that one also does not hold. And you see highs and lows being taken. This is how liquidity is being built. Liquidity builds up above and below. So you see equal highs and equal lows, or relative equal highs and relative equal lows. That is how to identify the accumulation phase. Then the manipulation phase. This is when price breaks out of the range. And in this case, the buy model, so price will break downward to trigger stop losses below recent lows. Now, this is the sell side of the curve, and also known as liquidity engineering. So, this is the stage where they are engineering liquidity for the upward move, and it's called the sell side. You can also call it the manipulation phase. And the algorithm targets with a stop loss, stop orders to gather liquidity for institutional entries. And this phase is where you see the smart money reversal. And what is smart money reversal? It refers to a sharp and aggressive reversal after the manipulation has occurred. After you see a manipulation weak or sweep, you will see a sharp and aggressive reversal. That is an SMR, smart money reversal. Now, I'll talk more about this in some other video. There are some things also to look out for to identify a smart money reversal pattern. This is when markets violently reject the low, creating a displacement to the upside. And this signals the start of the buy side delivery. And a fair value gap or order block is often left behind where price may retrace before continuing to the upside. So what are things you watch out for here? You watch out for fast liquidity grab below recent lows. You look for displacement candle back into the range. You look out for break of structure to the upside or change in state of delivery. And this is your signal that the way direction is about to begin. Now the distribution phase. This is the buy side of the curve. And this is where they removes the true intent of the smart money. And the decision begins driving price in the desired direction. In this case, upward, offloading their earlier positions as price climbs. This phase is often supported by bullish order blocks, see breaker blocks, see fair value gaps being filled as price tends upward. So all the fair value gaps, breaker block, or PDRs majorly created on the sell side of the curve will be used to deliver the price upward. They will now support price. They will be used to push price to the upside. And this phase is usually much more faster than the manipulation phase. The CM phase is very much faster. That is the momentum phase. It has momentum than the manipulation phase. It moves very quickly. And this is so that retail traders may miss out on those entries. So what are the things you expect? Bullish order blocks, look out for that. Breaker blocks, fair value gaps that are pushing the price upward. So you also expect to see clear higher highs and higher lows. These are structures forming in line with the new buyers. And this is where you trade with the trend and not against it. Okay, so this is how it's going to look like. So MM is usually called MMXM. The X can either be buy or the sell. In this case, the buy. So you have the original consolidation, then you have a displacement to the downward or an expansion. You have an accumulation, you have an expansion. So the original consolidation is also an accumulation. Then at this you have after the expansion you have another accumulation. You have an expansion, then you have either an accumulation or you just have a smart money reversal. Immediately you see a turtle soup will occur there or a sweep on the low and then a sharp upward move back. Then a fair value gap and other block will be created. Price retrace into that and then keeps buying. And then you can have a bit of retracement or a bit of accumulation, then you see expansion. And this phase, like I said, is usually very, very fast. And what should be your take profits? Your take profit should be the accumulation phase. That should be your take profit one. Then the original consolidation should be your take profit two. Also, you can look for another higher pivot point for your take profit three, because the distribution usually goes much more higher than the original consolidation. All right. So now to the sell model. Sell model is just like the buy model. So in this case, see price moves sideways as well. As price smart money prepares to sell, liquidity breaks both above and below the range. You see multiple highs and lows, and these are perfect stop loss baits. So what are the things you look out for? You're looking out for the same thing. Sideways price action, low volatility, false signals in both direction, liquidity building up and above. Then the manipulation phase, this time price spikes upward, grabbing buy stops and liquidity above highs. And then the traders enter long too late. Just before the reversal, then you have the SMR, which is a rapid move backwards. So what are the things you look out for? The same thing, past liquidity grab before below recent trend lows. Displacement candle back into the range. You have a break of structure, change state of delivery. Then the market distribution phase, you have the market now begins in with two directions, which is downward. So institutions start distributing their sales, and then price trends lower. And then you see fair value gaps, other blocks, and PDRs guiding price downward. So this is the diagram. So you see buy side of the curve, and then you see the sell side of the curve. So you see an original consolidation, see an accumulation, see smart money reversal, then the distribution comes, the distribution down to the sell side. Now, how to identify a smart money reversal? There must be an higher time frame key level. This is very important. An higher time key level must be engaged before it anticipates a smart money reversal and then expect the sell model to be activated. So it's basically the same thing. It's just mirrored. The buy side of the curve on higher time frame markets, make a sell model is basically a buy model on a lower time frame. So this actually depends on the time frame you are looking at. And to use market maker and sell model, it's best to use it on higher time frames, starting from 4 hours, daily, and then weekly and monthly. But 1 hour can still work. Can still use on 1 hour, but basically the best time to apply it is from 4 hour upward. Basically, it's best used on higher time frames. So the structure within the AMD model, like I said, it moves through across multiple assets and time frames, but works best on higher time frames. So in each cycle, you have clear liquidity close before the manipulation. So you will see clear highs and clear lows. Then you see sharp market shift candles after the trap. That is the smart money reversal. After the hard time frame key levels engage, you see a sharp reversal. Then you see fair value gaps, and then these fair value gaps are supporting the direction of the market, the opposite direction where price is supposed to go to. And as you master these models, you notice that price often follow this exact sequence. So I'm going to show you how to spot this model in real time using some examples. So what are the things you can look out for? So how can you spot them in real time? First of all, you can use your session timings, the Q zones. Then you can watch out for liquidity gaps, I said, followed by displacement. Then you confirm with the fair value gaps, other blocks, and market structure shift. And then you see that AMD is actually everywhere, from intraday setup to swing trades. I'm going to show you some examples on the. Now looking at this chart, this is Dow Jones, which is known as US30, and I'm on a daily time frame. If you look at this, you see consolidation phase right down here, and then you can see multiple equal highs, right, and equal lows. Then you see price displace upward, then keeps going upward, keeps going upward. You can see big displacement to the upside, big you can see displacement to the upside. Then you have consolidation, then you have smart money reversal. Here you have change in state of delivery, then price moves lower. So if you're going to take this entry, this is a December 2024 month high, we're in August 2025. So that's like a very important key level that was engaged. Then you see this high taking, and then a reversal. So you can see price is delivering lower prices at high speed. That's the smart money reversal above there. And then the first profit will be below the first accumulation phase. And then the second take profit will be below this second, which is the original consolidation. That this way I'm anticipating the price should come towards. And this same charts on 4-hour time frame. This here now is the accumulation. Now using the 4 hours, the original consolidation will be different. So you have the consolidation here. You have another consolidation. So you have a distribution above consolidation again. Then you have distribution above. Then you have this high getting sweep. And then you see sharp reversal. Just look for that sharp displacement lower. And this red candle fulfills that. And then after that, you see price going. You see price going lower. See a retracement back here. And what is this? 4-hour favorable gap. Send price lower. And you have a bit of a consolidation. Then 4 hours gap again, send price lower. And you have retracement. Then price comes lower. So you have two targets here. First below the first consolidation, that's target 1. Below the second consolidation, that's target 2. Okay, so that is on 4-hour chart. You can see that what we see on the daily chart is a bit different from what we see on 4-hour chart. Alright, now this is US100, which is known as NASDAQ, and I'm on the 4-hour chart. So I have consolidation, the original consolidation down here, another one here, and another one here. Then you have smart money reversal up here. This is a key level, also last year level down up here. Then you see price reject from up there. Then you see displacement. After these candles, displacement, this red, then you're looking to sell. What then do we have? We have market structure shift, or one can call. We also have a change in state of delivery. Then target 1 is right there. Second target is right here. And the third target will be right here. So this was some days ago. So I'm very sure that this level is going to get engaged. Okay, so looking back again, this is still the 4-hour chart, but if you scroll backwards, you can see that there is another consolidation right down here. Then consolidation here, consolidation here, consolidation here. So as long as the fair value gap, now I'm not automatically expecting price to come down here. It may come here, it may not. But how am I going to know if price is still coming down here? I must ensure that the gap, the PDRs on the downward move is supporting price going lower. The moment I see that PDRs on this side fails, then I need to take a break and look at what price wants to do. Okay, so price will come here as long as the PDR is on this downward move, keep sending price lower. So this is a potential target. Alright, so the same US100 NASDAQ, and this time it is one day chart, daily chart. So looking at it, you have consider is a big difference. Consolidation right here, the consolidation here. So let's see it's more clear here. Smart money reversal, that's a big rejection. And then let's see the following day, price keeps going lower, right? And then it's going to take out this low, after which there might be a retracement that will push bright price lower again to this next target. So I'm anticipating price to come lower because there's already a market structure shift, and then it changes state in behavior. So market moves, are factors, and every price zone, whether on the minutes, hourly, or weekly charts, can exhibit a complete market maker model. So this means the logic applies across all time frames. And this is something traders can utilize. What do I mean by that? Market makers are factor. Now, if you're looking at a buy model on the daily chart, we have a sell side on the top before it starts buying. And then on the daily chart, the sell side of the curve is actually a sell model on a long time frame, maybe a 1 hour time frame. And then that sell model, we also have what? A buy side and a sell side. So each of those sides can be a different model on a much lower time frame. So traders can utilize these time frames to capture retracement moves within higher time frame structures. So you recognize these swings, MMSM setups, allow to take trade entries and to manage your trades. So some traders they excel by selling retracement, which is the sell side of the curve in the buy model. And while other prefers to buy the expansion, I prefer to buy the expansion because most of the times I do trade the manipulation trades as well, but sometimes if I don't trade my stop loss, I get stop loss. So it's better to trade according to the displacement, which is the distribution phase. Okay. But if you're going to trade the manipulation phase, then you need to trade your stop loss. And then you know how to place your take profit at the perfect place where you can expect a smart money reversal, those key levels. So the framework accommodates both trading patterns depending on your personal risk and trade psychology. So each model structure has multiple accumulation and reaccumulation phases, offering several possible entry points. And you must understand where stops should be placed. This is critical for risk management. All right. So, like I said, most traders get trapped in a manipulation phase. It can happen to anyone if you are not very clear on the direction of the market or the trend of the market. It does happen to me. Now, thinking it's the real move, but once you recognize the accumulation and trade pattern, you can wait for the smart money reversal confirmation and trade with the flow and not against it. So, what are the things you have to do next time you look at the charts? What are the things you try? Mark out ranges where price is consolidating itself, and then watch out for sudden manipulation for spike. Identify smart money reversal. and then align with the move that follows. Now this structure will give you the timing, the direction, and also what precision. So if you have ever seen this on your chart, so if you have seen this, AMD pattern play out on any of the markets, just let me know in the comments. If you also have any question, so let me know in the comments. And if this brought clarity to you, can just like the video and share with a Twitter friend, and also subscribe, for more insights and for when I drop new videos. So in the next lecture, I'm going to go deep into AMD framework, how I use it and how I use it on a daily basis and basically on 1 hour time frame, lower time frames. This video is the 7 and buy model of this is focused on higher time frames. But then I'm going to show you how to use the same framework on lower time frames and how to take entries. So until then, trade smart and then review the charts, mark up examples, and then analyze this lesson. And you won't know it just by looking at the videos. You need to learn how to practice yourself, looking at the charts yourself. That's how you can get better and know how to recognize this. Alright, once you're done, see you in the next lecture. Thanks for watching.